Hey guys, it's November the 9th and election day. I don't know that this was necessarily anything. I mean, stocks fall as control of Congress remains up for grabs. This is how it works almost every time there's an election these days. So, I don't know that that's as big of a deal. I've been really surprised how Europe's hung out. We're going to go through, I'm going to stay on the non-controversial stuff. You guys know how I feel about Tesla. And obviously Elon's selling it. He's a big seller, so it's going to take a little time for that to work itself through. I mean, it's really strange because there's lots of weird arguments out there. None of them actually relate to any kind of meaningful valuation work because they all are related to revenue. It's like we're public equity investors. We're not private equity investors. We actually care what the company returns, and the company has gotten through the worst part of raw material nasty, with like a lack of a better way to say it. So, it's very strange. But with one gigantic seller, it kind of is what it is. Now, I'm going to go through just the briefest on Mondelez as relates to what they're showing. I don't necessarily think this is the right timing for it. And then we're going to talk a little bit about Disney, because I know David always cares about Disney. And then I'm going to talk about Norwegian Cruise Lines. Believe it or not, they reported, and I think it might actually be time to start building a position. These markets are so skittish. You want to be careful no matter what you do. But in fairness, Norwegian is kind of interesting. Let's go through it. Past performance is not indicative of future returns. On my screen, the markets look ugly. I mean, is this the election or is this CPI coming out tomorrow? It's very hard to say. The expectations for CPI, they kind of are what they are at this point. And, the momentum that's going into the fourth quarter, goodness, after CPI, we immediately have retail sales. And so and then we have the fourth quarter holiday season of what's going on. We definitely have some companies that are doing great. All the energy companies are doing phenomenal, but they're trading with this index, the crude oil index. And it doesn't make any sense, but that kind of is what it is. Because it's really funny because it is a multi-year cycle they're going into, just given what is transpiring right now. When you have these gluts where there's a disruption in the creation of oil, but you still have an increase in energy usage, you don't make it up very easily, for lack of a better way to say it, because you literally ran backwards for a while. So when crude oil is going to bounce around a lot. And my suspicion is the gaming gets worse before winter sets in late November, early December. We had some very warm days, so there is that. But now it's actually gotten quite cold. But it's going to trade very volatile, and then it's really, did you have the energy or did you not? So there is that. Okay, on the map of how we're seeing things, you can see that big cap tech is more or less giving it all back. Tesla continues to get clobbered because there's a known potential seller. Whether or not he's done with it or yet is hard to say. I mean, I would be really concerned if it wasn't that we all knew he was selling the stock because of Twitter, and that kind of is what it is. But there's nothing wrong with Tesla. And if anything, like I said, Meta going up this much, 6% today. Okay, I'm going to take it off share. Meta up 6% today. It's a really tough call. Now, you guys know that I was like, it's too early to buy Meta because he's spending like crazy to try to spend for the future. And I just don't know. I'd need to see another quarter. You kind of do need to spend, but at the same time, it's a little aggressive. Okay, those videos, you can see them all the way back, right? But up 6% off of an apology and firing people, I mean, it's really strange. So I read the release, and what he's saying is that he doesn't have it. Do you know what I mean? Like, he's saying, I made the wrong call. I thought that revenues from COVID would stay where they're at to help me fund this new change. And so then I went ahead and took the initiative to go ahead and transition the company forward toward this new change, not, knowing that we're going to probably have to not focus on some other things associated with that. And now I've got to fire 11,000 people over the course of time in front of the holidays. So for me, that that isn't a buy signal. That might not be a continue to sell at 80 signal, but it's not a buy signal, because it does indicate that he's already seeing that he's not going to do anything close to what he thought he was going to do in the fourth quarter. So he can't even hold the head count through the holidays. I mean, you really got to understand, if you've ever been on a management team, and for some of the viewers that are a little bit older, if you fire people in October in front of the holidays, yeah, you're going to give them severance, but at the same time, it's not a decision taken lightly. Things got to really look bad at that point. So I don't understand that. I'm just going to say that. I'll do a bit more work on it. The fact is, the stock cosmetically on a valuation basis does look cheap, but unfortunately, because you can't tell what profitability is going to be and you can't tell what revenue is going to be, it's unclear where he's got to go in the future. And he's already told you that there's an issue with his business. It's really hard for me to be like, yeah, this is the right valuation to step in and buy it at, because remember, something that's cheap can get cheaper, especially if it's not making money. All right, let's get back into it a bit and talk about the two that I think are probably more relevant to start to look at, because with CPI, with some of the things that are happening, you can get these blips. Now, do I think the US economy is reasonably strong despite all these big tech sell-offs? Yeah, the answer is actually yes, because oddly enough, if you listen to the companies that are doing well, they still are looking for exactly the headcount that everybody is letting go of, believe it or not. It's very strange. Take-Two came out and they were kind of thrilled. It's really funny because their investor was not a very humanized person. One day I'll do like bloopers from these calls where investors ask questions in the nastiest possible way, and management has to come back and be like, well, we don't actually treat our employees that way. But the way they said it was, look, we actually feel like we're in partnership with our employees, whether that's true or not. I don't know. I don't work at Take-Two. I don't know, but they are excited to take in the headcount that any of the big cap companies might want to spit out or slow down on hiring. If you've got talent, there's a place for you in technology. So I don't see a major concern there. Do I think that you'll get some lower employment numbers? Yeah, but it was always the blue collar worker that we were concerned with, not the white collar worker. So let's just call it what it is. Mondelez, I want to show you. Look, I don't think Mondelez is a buy right this minute, because he's taking a very specific bet. And do I think it's smart? Yeah. Do I think that it could go either way for him? Yeah, I do, unfortunately. Okay, but this is what he showed, which I think is really important. And that is that Latin America, that business continues to grow at like the highest possible rate. I think it's been growing between 20 and 30% this entire time. And it's both volume and mix. It's not just that he's just gouging the poor Latin Americans on pricing, even though there is a bit of that that's going on. The challenge is that he's got rising raw material costs, and he kind of has this thought process that some of it might taper a bit for him in the back part of next year. And so he hasn't hedged the same way that he's hedged all this year to crush his competition. And some of his hedges the end this year are going to roll off. So I don't know how to even think about that. I will say it's a really good management team. So I'm very hesitant to say anything negative about those guys, because I really do appreciate their acumen as leaders. Now let's talk about Disney. Okay. Here's the thing I'm going to say about Disney. I'm going to go through the quarter in just a second, but they are definitely transitioning the business. And it was very interesting because the CFO's component of the call is usually about half the length that it was this time. And the reason she took the extra effort was she really wanted to talk about the fact that they are going to hit a pivot point right now on the media portion of the business. Now, there are two ways to interpret this. One is that if you're a little bit more shorter in term, this thing's going to be volatile until such a time as those earnings demonstrate very clearly that management strategy was right. On the other hand, if you're an investor, this represents a very notable strategy on the media side to actually compete against Netflix, if we're honest with what it is, but not really just Netflix, because I don't think Disney sees Netflix as their biggest competitor. I think they see the entire space doing a very specific set of things. Let me go through the numbers and show you what I saw in the quarter and what I'm understanding from what she said. Okay, let's take a look here. I'm gonna share my screen again. This is what happened. You've got top line revenue up 8.7%, net income down here is up 1.8%. Operating income was up 30%, but there were these really bizarre charges right here, income tax, okay? But this number, not helpful for really understanding everything that they were trying to tell you about. This is the segments, okay? Disney Media ate it, but not really because of the strategy. So we're gonna go through that. I told you that I knew this parks business was going to be strong because this parks business represents what everybody else from Livewire to Expedia, Booking, and even Royal Caribbean, or sorry, Norwegian Cruise Lines. So sorry, I got it wrong. Even Norwegian Cruise Lines, which I just talked about, people are spending money on experiences. And Disney parks have not even fully opened back up. This is up 36%, but this was not like if we compare it to pre-2019, pre-COVID, this is actually still a really strong result. They are definitely going to the parks. And when they are going to the parks, they're spending. And there's still a lot of things they can do. Now, some people may be concerned, like this is here, let me show you. Operating income was up well over 100%. So we're almost at like like 100, call it 30, 40%. Okay, there were a lot of questions about, are you concerned about global GDP slowdown? And they did speak to them. They do intend, if necessary, to discount, but not nearly to the way that they used to do it in 2019, when even with the parks doing great in 2019. So I'm not worried about the parks business, especially for the next few quarters, even with GDP slowdown. Okay, I want to show you this though. This is what happened. Okay, so this is the media business in transition. These are the channels business. This is Disney Channel from cable. Down, 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 down. Painful. Okay. But this is the subscription business, Disney Plus. And so what's happening and what they're doing is they are 100% taking the money from and winding down. I mean, I don't really know another way to say it. That might not be the perfect way to say it, but it looks to me like they're going to wind down a bunch of this business and make sure that they get this business. And part of how you can really see it the most is if you look at international down 18 versus up 57% here, you can kind of see what they're doing. So how do I think about this? I think they're tired of paying the stations. That's how I think of it. Do you know what I mean? I think they saw the growth, they see the writing on the walls. They know that if they get this to be the same size as that business, they get to keep pretty much every part of it and pay a very small fee versus a very large fee to the cable networks, et cetera, let alone have to do this whole package nonsense that every single content provider has had to do. So this could be incredible once the transition's done. But it's such a big part of the business that it's a little bit difficult right this minute. Now, down here is the pricing. And they did tell us that they were going to increase pricing. And they announced that they are going to do ad revenue just like Netflix. That's why I said it's clear to me that they're going to try to like not let this ad revenue nonsense be the reason why one of their competitors gets bid up in the marketplace and they do not, or one of their competitors even has a leg to stand on against Disney Plus. So know that is going on. It's a very interesting situation there. But for me, it's a 1 quarter situation. Now, if I've owned Disney for ages, do I sell it here? No, but I might hedge it going into the 4th quarter because, you know, this will continue to look a certain way. Sorry, a little fungus, a little fruit fly coming at me. It's going to continue to look a certain way until it doesn't. And then it'll be off into the races. All right, now let's go into Norwegian Cruise Line. Okay, as you guys know, we have been pretty bearish, the cruise lines, this entire time. The St. Petersburg shutdown was a really profitable port for the cruise lines to come out of. And, you know, with the conflicts that are going in the Black Sea region, those aren't running the same way. It was a very interesting earnings report from Norwegian. Norwegian is the 3rd largest. It's not a huge cruise line. They have far less boats than a Royal Caribbean or a Carnival. But they do run international and they are a meaningfully sizable a cruise line, but they do have a relatively richer client base, let's call it that, than even Royal Caribbean and Carnival, given just the sheer raw size of who they're trying to service. Now, let me show you what actually happened in the numbers. And in fairness, unlike the airlines who keep comparing themselves to 2019, the cruise liners are like, no, we just want to forget how it used to be and work with what we have. 2020 isn't worth comparing to, by the way, as well. So this is last year. These guys are running at the middle of the year, at best, they were running 30 to 50% capacity. And Norwegian was the most aggressive about making sure that everybody had mask only and we're fully vaccinated. So all of that's more or less been lifted at this point. So there's no need to wear masks. The vaccination restrictions are calmed down significantly. So this is what revenue looks like, right? And if you take revenue and you subtract operating expenses, you end up with gross margins that are 30%. That's really close to what they used to make. So that's not bad, actually. The problem is all the operating expenses. That's why they came in negative, but realize that in that is D&A. So they gave you D&A so you don't have to do the EBITDA calculation by flipping through everything. And so EBITDA, if you take the 186 and add it to the operating loss of 185, you're actually flat on EBITDA. And I was like, oh, that's way better than I expected. Now, a couple of other things, just want to show this to you. This is operating income down, this is a huge improvement, right? Like we're mostly through it, realizing that a huge component of that is prepaid expenses. That's what is coming out of the operating number, and also loss on extinguishment of debt. Now, here's the thing. We all know that these guys had to sell off ships and borrow what they could. So how does that look? Here's the debt schedule, okay? Do they owe some money? Yeah, they do. They owe like $1 billion in 2023. They'll be fine on this 332 because it looks like they can cover it. And then so on and so forth. And then the debt actually has as its highest rate 7.75%, which, by the way, guys, isn't actually that bad for something this distressed. Now, that's the highest debt cost that I saw in the 10K, unless I'm missing something, fine. These companies do in particular have really funky structures sometimes where one cruise line is actually in this weird subsidiary somewhere, but I don't think this is so far off. Now, what's interesting is a lot of this, particularly in the front months, is actually structured to convert. So if they don't pay the debt, it converts and we get diluted as the shareholder, but we move on. It's really what it is. I'm actually kind of okay with that given where it currently trades on a book value basis, okay? Because that's really what we're talking about is what's the price of books at this point. Earnings isn't going to be the right metric, EBITDA isn't even really the right metric at this point unless you're really a growth-oriented person willing to give them credit for the future without a proper share count. That's cool, you do you. But like this actually, if these things start moving in the right direction, I think they can pay this and I think they're going to be just fine. Now, I want to show you some things. Here's the occupancy. Here's their clients. Actually, the occupancy is here. Here's the occupancy. It's already in the mid to high 80s. So the hotels, this is actually kind of close to what the hotels are running at this point. Hilton, Marriott, it's pretty good. And it's 20% less than 2019. Hilton and Marriott is a little bit higher than that. Just realize as well, for a cruise ship, occupancy versus 2019 is very different than occupancy rate. Occupancy rate on a cruise ship is total number of passengers divided by total number of berths, okay? That being the case, we all know that if you bring your friend on the cruise ship with you, y'all get in one room, but yet it's going to be counted a certain way. So there is absolutely a way for them to surpass the 2019 number, just saying. So, that actually looks like a huge improvement. I'm really happy for them, quite frankly. The other thing I would say is this was very interesting. So they did kind of a survey to just try to explain why they felt like they can get the pricing power they're getting, because they're definitely getting pricing if they have 30% gross margins right now. The reason they feel like they can, these are the upscale berths, is because the percent of like 95% over 90%, let's call it, in these two brands, Oceania and Regent, which is their hot luxury brand. Those people they make $250,000 or more in income per year. Norwegian is the one that is more, common folk oriented, bigger boats, etc. And that's still over half of the folks. The last thing I want to show you, and this is really kind of important, this is the revenue distribution. It's not compared to years past. I wish they would have, because I think you would have seen that Asia Pacific, which is still a fraction, less than, I mean, for the year, it's less than 10%, but it's improved dramatically in this quarter, these subsequent quarters. It's still a really small component of what's going on. Let me tell you something. Asia was a big cruise business in 2019. And if you're ever confused, just pull up pictures of the port of Singapore, okay? And you'll see that there were a ton of Chinese people flying into Singapore, getting on boats, gambling like crazy, and then going back to China. And then even Macau had that interest in that business as well. So that absolutely, if we get Asia opening up, could be really positive for Norwegian and actually all the cruise liners. I'm excited to see what the other cruise ships do before I really get bullish. But, this is a stock that's like $16. So every now and then I like to just find companies not that are cheap from a valuation perspective, because I don't necessarily think this is either cheap or expensive, quite frankly, until we really understand the growth prospects. But it's cheap from a people can afford this perspective. 1 share, 2 shares, 3 shares. They don't have to go to fractional to be a shareholder. And with that, I'll take questions. It's a mouthful. Hopefully everything's okay.
Yeah, great. I think it's important to when you buy something, you can also hedge it. I mean, so you protect yourself from the downside risk.
Yeah. I mean, with something like Norwegian, because
We've always done it at Disney.
Oh yeah, for sure. With Disney, I mean, I probably should have spent more time talking about it yesterday. God, yeah.
Yeah, I mean, so we're protected. I mean, if it goes up, then
you're really good about that.
Goes down, we're protected. So Tesla, the reason he's selling has nothing to do with
the company. Yeah.
Tesla as a company, right?
Yeah. Like usually a CEO selling triggers a real concern and a massive reaction, but because the reason, it's not like you have to get as intense. The crazy thing too is if he finishes selling and the stock is really, really low, then he can actually buy back his stock cheaper and he will have made money from selling it, and then buying it back. There's lots of CEOs in history that have done it in the most impressive way. Steve Wynn actually does that occasionally to his stock when he gets financing or something like that. There's like in the 90s, when I was starting my my role at investment bank, whatever, blah, blah, blah. You guys know my history. But like one of the stories that cautionary stories to a young analyst was actually that particular trade that Steve Wynn did with Goldman, where he kind of basically sold his stock and then bought it back from a financing perspective. It's like so weird, but it is something that can be done if the market just wants to give Elon a double payday. That's very interesting.
Yeah, I mean, technically it's going to be tough under 180. Those are 2021 lows. So I don't know why he would, I don't know. It needs to hold here.
It's so weird because the Reddit boards are all about the revenue. They only care about the revenue and they can't see the revenue continuing to grow. But that's that kind of thing is like so how do you be a lover of Tesla and then suddenly believe it can't grow aggressively into the biggest EV support that's ever happened on the earth? In the lowest inventory of autos that you've seen. I mean, the one thing that could be problematic for the stock is just if we get a really weird number off of CPI on new car sales, as people just try to figure it out before the holiday season. Usually the fourth quarter for new car sales is actually quite good. There is seasonality to car sales, period. So it's a really aggressive call, I will say, that the others, we'll just call it, are making. Additionally, it's, to me, and no one seems to care that used to own the stock, it's actually about profitability. And the company just managed to maintain twice the margins of pretty much the next highest sort of auto manufacturer. And that was through the worst part of supply problems. We're actually coming around the corner on that. I'm just like, wow. And then on top of it, the one business where I was like, what is this business? And does he really like, does this really add value? The power generation piece, the batteries piece, that's actually really starting to show some aggressive legs. And if anything, that to me has greater potential than even the autos business, just because of what has to happen to transition the world over the next 10 years or so. But no one cares. That's what I learned today as I was just trying to just politely ask different people in the like online community. They're just like, ugh. But I should know better at this point. No one cares sometimes about valuation when the market is completely red.
Yeah, but you have a very strong seasonality of the market up this time of year. So if you get a negative CPI and the market dumps, and that's a buy point.
Yeah. I mean, we
Okay.
shall see. All right. Good luck, guys. Good luck with CPI and good luck with whatever happens with this election. Take care.